The broadcast is now starting. All attendees are in listen-only mode.
Hey everyone, thanks for joining us this evening. We're going to go ahead and get started in just a minute here. Really appreciate you taking the time to hop on. We know everyone has a lot going on right now with this virus and everything else. So, just the fact that you're on this, we really appreciate you hopping on, and hopefully we can share some really good information with you this evening. I'm here with my partner Lior, and I'm going to let him introduce himself in a second. I just wanted to do say a couple different things. If you have questions, for those of you who are new to the webinar platform, you should be able to put questions into the right-hand panel over there, ask it, and when we take periodic breaks throughout this thing, we'll stop and answer your questions. Hello, hi Vicky, how are you? Definitely works. So yeah, dump your questions in there. Anything you have, anything that doesn't make sense, we'll kind of slow down, say it in another way, and share with you. So we're gonna probably move a little quickly this evening. We're gonna try to cover a lot of information. We're gonna try to keep this to 1 hour max. I understand that a lot of people have children at home, like myself, and we're going to try to, like I said, get you back to dinner, children, and everything else while still sharing some information with you. So we're going to go ahead and dive right in. Tonight, we're going to be talking about 20 for 20. So our goal at the beginning of 2020 going into this year was to buy 20 more rental units together. Lior has some stuff that he does on the side. He's bought, a couple more rentals this year himself. I've done some things, family members, friends, and other partners that we have, but together we were shooting for 20 units, and we want to show you we are not quite there yet, but wanted to show you how we planned on getting there and the progress that we've made so far, and hopefully it'll provide some insight in how you can continue to build your real estate portfolio as well. So that's what tonight's about. We're going to dive right into it, and like I said, for those of you just hopping on just now, like I said, please put your questions in that box, and we will get them answered as we go along. So 1 second. Just want to I'll introduce myself, and then I'll let Lior kind of take it away. For those of you who are new to Boston Wealth Builders, just hopping on this or just part of just joining this group, my name is Willie Mandrell. I'm the organizer of the group. We started this back in 2012. It has grown incredibly. It's a great networking platform. Met a lot of wonderful people, a lot of great connections. Made a lot of money through this platform as well. I would encourage you, if you're new, to not only once we get back up and running and we can actually meet in person, to get out there, network, and really meet the people in this group, because there are some wonderful, intelligent, motivated people that are members of this group that are consistently on webinars like this and our live meetings when we're available to have them. I'm an investor myself, been investing in real estate since 2006. Right before the last time this happened. We're going to talk a little bit about that. I think we'll kind of open up with a short, conversation on where we are and how this virus and the current market has affected us. I also do some consulting work, do some mentoring work for a couple newer investors, and then some coaching for a couple of groups that are, getting together, looking to get into the business. So that's kind of me in a nutshell. And I will let Lior kind of take it away and kind of give you, his introduction.
Hey everyone, I am Lior, Willie's partner over here. So like Willie said, I've done I started investing not quite as far back as Willie has. I bought my first place in 2016, bought a couple of properties on my own, did a couple of condo developments in East Boston, learned a ton, learned the ropes, and we've kind of been rocking and rolling the the buy and hold model since. So in addition to being an investor, I'm also an agent and a team leader. I run my own group over at Compass, where obviously a lot of my work is on the investment side, right? So dealing with multifamily development, all that stuff. So I kind of merge both worlds of the investing and brokerage together, and that's what I do on a day-to-day basis.
Yeah, and as a quick plug for Lior, I mean, he's one of the things that makes him a great agent, as well as a great partner, is our strengths work well together, right? I mean, I'm more of the financier on a lot of these things, recruiting private money, working with the banks, whereas he's out really crunching numbers and acquisitions, and we'll kind of go into a lot of that as well. But one of the things that makes him a great agent is his ability to go out and build rapport with different sellers, he through that is able to bring in a lot of new listings and opportunities to invest as well. So if you're an agent out there and you're listening to this, if you're interested, Compass is obviously a great company. It's not one of the, it's one of the more popular brands out there. Him and his partner Taylor are doing, some incredible things. And if you're looking for a home, these would be some great guys to talk to about possibly joining their team as well. So let's dive right in. We're going to talk about the BRR strategy, but first, before we get there, I know what we're going through right now is a tough time. There's a lot of things happening, a lot of moving parts, a lot of uncertainty. People don't, as well as myself, don't know what the next day is going to bring. But Lior and I have this conversation on a regular basis and wanted to share some of what we're doing mentally, or not mentally, but the mindset that we're coming into this with. Back in, like I said, I mentioned I bought my first home in 2006. The market crashed, stock market crashed 2008, 2009, housing market not too far after that. So I've been through this before. One of the mistakes I made last time was putting my head down, feeling sorry for myself, making excuses. These are the opportunities. This is an opportunity. There's a lot of investors that have been sitting out there for years saying, I'm waiting for the next market crash. Well, here it is. This is it, right? I mean, I'm not certain that the housing market will follow the stock market, but there are going to be people hurting, and unfortunately, with that comes a lot of emotional decisions and everything else that comes with a bad economic market. And for those of you with a steady hand, those of you who continue to educate yourself, continue to keep your eyes open, there are going to be opportunities, whether you like what I just said or not, and whether it sounds insensitive or not. These are the facts. This is part of the economic cycle. This is the cycles that we go through. I took a major hit on the last one, and there's going to be some major wealth transfers taking place. And as a group, we collectively motivate each other. And I would encourage you to get with people who are like-minded and think like you, and continue to keep each other focused on the opportunities that are going to come in the next couple of years because of what we're going through right now. And I'll let Lior kind of speak to what he's thinking about and see things that he's seeing out there.
Yeah, and I'll kind of tie it in with what you said, Willie, about to a more operational basis. So, now that you kind of have that mindset down in terms of like, what are you actually looking to buy today? What from my conversations with a lot of big developers, investors, much bigger than we are, to smaller guys. I mean, now more than ever, you have to be rooted in your fundamentals. So really, really buying for cash flow, not speculating right now. Really understanding how to run good numbers, making sure that if you're doing some sort of value add deal, that there's enough equity spread in the deal so that you're protecting yourself against any. It could possibly get worse, it could possibly get better, but you have to have good safety margins today. So this is really where it gets down to learning, understanding the numbers, understanding the cash flows, and making sure you're not putting yourself in dangerous position moving forward the next 6 to 12 to 18 months.
Agreed. So yeah, I mean, if anybody other has any questions about that, about our strategy, mindset, things that we're doing to prepare for the opportunities that are going to come up, please let us know. Like I said, enter it into the questions. But other than that, let's move right into the material for tonight. Lior and I focus on we don't buy rent-ready properties too often. I think we've got a couple of them, that we've picked up. But for the most part, we're looking for the real dogs, the ugliest property on the block. And for those of you who are not familiar with the BRR strategy, it's the buy, rehab, rent, and refinance. The reason we love this strategy, as you can see right on the screen, the number one thing that we love is when you buy a rental property in a conventional fashion, you put 35, if it's FHA, or 50,000, or whatever it may be, to 150 to 200,000 down, and that money is stuck inside the property for a period of time until you create an 80-20 ratio or 75-25 ratio, and you can pull that money back out. But until then, your money is stuck and it's not really moving. With the BRR strategy, the best thing about it is that we keep our money moving. You can improve your return on investment, right? if you put $100 into an investment, if you put $100 into an investment and you get, if you buy $1,000 investment, you put $100 into it, you get, some money back. That is your return on investment. If you don't have any money in that deal, your ROI is infinite, right? And that's what we're focused on. If we're putting money into something temporarily, pulling it back out, your ROI is absolutely ridiculous, right? So, I mean, that's one of the reasons that we love this strategy. We can buy more rentals faster, obviously, if we're putting money into something, taking the money back out. We can go and use that money to buy more deals. There's less competition for rehabs. The stuff that we're buying, the tenants are paying a ridiculous amount of rent. They're probably paying, for those of you familiar with the Boston market, if you're paying $800 for a 3-bedroom apartment, that's a problem for the existing landlord. We're going and buying stuff like that, or we're buying stuff where the roof is caving in, the foundation is leaking, the windows are all in disrepair, or leaking heat, or whatever it may be. We're just looking for the worst properties that we can absolutely find. We want the absolute dog on the street. We don't want to do cosmetic rehabs. We want to do the full gut. Or what we started doing is some of the new builds as well, just because we can create more equity at the end of the day. And that's number 5, a good chunk of equity from day one. While most people are buying into something and waiting for the property to appreciate, we're forcing the appreciation from day one, right? We're buying at things at, and we'll go into the model a little bit deeper, but 55 to 65 cents on the dollar, meaning if we think that the ARV, or the after repair value, is $1 million, we're trying to get into these things for $550 to $650, depending on how much we need in terms of rehab, and we'll get into a little bit more of that. But we're forcing the appreciation and creating equity versus just sitting around and waiting for it. So that's the BRR strategy. That is 80%, 85% of what we're doing nowadays. And we'll get into kind of the details right now. So we talked about numbers. This is the cleanest form. I know some of you who are a little bit more advanced right now are probably looking at this and saying, well, there's a lot of missing pieces and assumptions, and we can kind of go into that. But this is the cleanest example of what we're trying to do. We're trying to find right now, let's call it 3 families. We find that obviously single families and Mass are just not, there's just not enough, equity play to do that, right? 2 families are really tough. There's not enough cash flow from 2 units. 3 families are the sweet spot. 3 families are we were finding the most opportunity to create this model and to actually to buy property. We have 1-4, but they are very rare. We'll show you the 4 family that we just recently bought in Roxbury. But 4 families are rare, and then once you get beyond that, you start to get into new competition. 5 families or above, or 5 units or above, is commercial real estate, and there's a whole nother market for that, right? You have more sophisticated brokers. The sellers tend to be a little more sophisticated as well, and there's just less room to create equity when we get there. Not that we're not looking. We just tend to stay in that 3 to 4 family market. But we're typically looking for properties around the 550 purchase point. Again, windows, roof, siding's bad, heating systems are gone. Everything is just wrong with this place. That's why we're able to go in and make a 550 offer on something that's a 3 family. Most of you are probably thinking right now, that is absolutely crazy. How are they finding properties at 550 to 650 when I'm seeing them out there for 850, 900? That's because you're looking on MLS, and we are not very rarely touching anything on MLS, and we'll explain. I'll let Lior kind of explain how he's finding things and where he's going and stuff like that as well. Rehab costs, $200,000. Other financing costs, you're going to have taxes, water, insurance while this place is vacant. As soon as we pick it up, we start paying interest on the mortgage, we start paying taxes, we start paying insurance. A little bit overages and other things. So we just say, to keep numbers simple, 50,000. We are now into this property for about 800,000, and we're estimating that the ARV is roughly $1 million. So we've created, whereas most people, if they went out and bought $1 million property, they would put $200,000 down, right? And now your money is stuck in the property. We've bought this property at 550, into it for 800, and it's worth $1 million. So an LTV, or a loan to value, of roughly 80%. We have $200,000 in equity within this property now, if that makes sense. So if we look at this, and I'm going to let Lior take over in a second, but if we look at this from how do we get this finance? Why does that work? Or how do you get this finance? If you buy this property at 550, and let's say hypothetically, we're right here, how do we finance? We're using a commercial lender and a private money lender, or PML, right? So the purchase price is 550 and the bank wants 25% down, or 137.5. The rehab cost is 200,000. So in most of our commercial lenders, they're asking for 20 to 25% down, but they're going to finance 100% of the construction costs once we get into this thing, right? We mentioned $50,000 for carrying costs, financing, other expenses. So the total that we need is about 187.5. Total capital raised from private money lender, 187.5. This is so we're going to go through the rehab and rent period. At the end of this deal, assuming this is let me back up. There's two pieces here. The initial loan that you get from the lender to purchase the property and rehab it, and then the lender that we're going to use to refinance out. So if I correct myself here, this up here is considered a hard money lender. This is the refinance period down here, and this is going to be our commercial lender. So total capital needed, 187.5. We raised that from a private money lender. But after that, the total hard money debt at a refinance is 612,500. This is the 550 plus the $200,000 that we put in construction, so 750 minus that 137.5 down payment. That's how we came up with that number. The new ARV is $1 million. The new bank loan that we're allowed is an 80-20 ratio. So if we only owe 612 on this property, or 612,500 on this property, the bank is valuing the property at $1 million. We can now basically go up to $800,000 loan, meaning that we could basically take out, why did I put 137? This actually should be more. This should be the 187. This, I apologize. This number is off by 50,000 right here. This should be 187.5. So essentially what we're doing is, if we can do a max loan, we have $800,000. We can go, we only owe 612 to the hard money lender. We basically can now do a cash out refinance of 187,500 and now pay that money back to our private money lender. Does that make sense to everyone? Hopefully it does. And if not, please put the question in the box. I'm sorry I kind of botched that number at the bottom there, but this should be 187,500, exactly the number that we used and borrowed from the private money lender. We're now doing a cash out refinance, paying that money back to the private lender. I know that there's some holes in this because I'm trying to keep the example super clean. Technically, this number will be a little bit higher because we'd have to pay the hard money, or the private money lender interest. But to try to keep the example clean, that's essentially what we're doing. If you look at it, what did we do at the end of this? We now still own a 3-family property that's worth $1 million. We've got a $800,000 commercial loan on this. And we've done this. This is actually a real, very close to a real example. We've created $200,000 in equity, meaning the property is worth $100 million. We owe $800,000 on it. And at the end of the day, the $800,000, the mortgage, taxes, and insurance on $800,000 were covered by all of the rents collected, plus a $200,000 cash flow to us. And that was essentially with none of our own money in the deal, because the private money lender was paid back, the hard money lender was paid back, and now we just have that primary note with the bank. And hopefully, again, I botched that up a little bit with that last number. Hopefully that makes sense, but that is essentially our business model and what we're doing with each one of these deals. So before we get into this, I'm going to let Lior kind of take over and talk to you a little bit about these specific deals that we're doing. A couple of properties, going to show you a couple of properties that we've recently bought, how we finance them, and kind of get into the details. So give me 1 second and let me let Lior take over here.
Awesome. And can you see my screen?
I cannot yet. Now I can. There you go.
Yeah, so I'm going to give a couple of examples. So of the 20 units that we were talking about up front, I'm just going to go show you guys what the properties look like. as well as how we analyze the deals. Particularly, I'm going to focus on the cash flow because, again, it's kind of tying it back to what we talked about originally with the market shifting and everything. It's critical to be understanding how your building is performing and making sure you guys are not putting yourselves in like dangerous situations. So we'll start with like the most simple deal and kind of work our way up in complexity. So probably this is one of the simpler deals we did. So if you can see my screen, this is the 4-family in Roxbury that Willie mentioned. This is it's a Dudley Square, kind of the north, if you know Dudley Square at all, it's kind of the northern part of it, which is a great area that we really like. And what I'm going to show you, I'm going to pull up my Excel. And so if you guys can see my Excel, this is basically our typical, we call it our cash flow underwriting sheet. And this is how we look at, analyzing the deal and making sure that, though we're trying to create equity, we got to be cash flowing as well. So in this deal, real quick, you can see that, here's our purchase price. We bought the building for $925. And I'm just going to run down through these line items real quick. If you guys have any questions, just put it in the chat box. We always budget some closing costs, which are attorney fees, lender fees, all that stuff. This is this next section here is the repairs. So again, as Willie mentioned, we get a repair budget from the lender. On this particular deal, we bought a completely occupied property that had tenants that were paying below market rent. So we had this one is kind of more of a small rehab. We're only going to be doing light updates to the units. That's all they really need, light cosmetics, to get them really to good quality rental units. Now you can see, again, we're using commercial loans, so we've got a 25% down payment, and we're going to be financing 75% with the bank. So total loan amount is basically just going to be adding our down payment as well as our upfront repairs. So now, and if you look at here too, what's really important is I've got 2 columns. Column D right here is the property with its current tenants and its current cash flows, whereas column E is what we think we can do. So in this particular property, we had all 2-bed, 1-bath units, and this is the rent roll we bought the property with. So when Willie talked about buying distressed property, sometimes the property is distressed in the sense that it needs a ton of work. Sometimes we're buying these properties that might not be in that bad condition, but a lot of these, some of these owners that have owned these buildings for 20, 30, 40 plus years, they don't typically keep up with market rent, and their rents are very, very low. So we were basically able to negotiate a pretty good discount on the building because we were buying the building with these low rents. So you can see our average, we're getting basically $1,200 for 2-bedroom units. What we think we can do within 1 year, which is market rent, is about $2,200. So it's quite a significant jump. Almost $1,000 per unit. So if you look at our total income, what we think we can do is change it from $5,000 to basically almost $9,000. So almost a $4,000 shift in monthly cash flow by stabilizing these buildings. Now I'll quickly run through these. So again, in all of our numbers, we always want to account for operating expenses. And this is, again, if you're not careful, this is where you can run into trouble, because it's not only paying the mortgage and it's not only paying the taxes, there's quite a bit of other things that go into it. So we always do a vacancy budget, which basically just is a allocation, is basically an allocation for the fact that you're never going to have your units 100% rented all the time, right? You're always going to incur some sort of turnover within one unit. So that kind of is a little budget to protect you. Next, we have a property management. Budget, because again, even though we self-manage right now, it's once we stabilize these buildings, we do want to hand off the buildings to property management, so we don't have to do the day-to-day on that. And around the Boston area, they typically charge 6% of the gross income. Next is repairs and maintenance. So this is kind of your daily issues, like a leaky toilet, something wrong with a faucet or whatever else it may be. We typically allocate about 5% of the total gross income per month. You then have your common water and sewer, pretty straightforward. Tenants pay their own gas and electric. We pay the water and sewer bill. And then we always do one other, I call it the additional other budget. we own enough properties where we've seen that things just come up. Real estate, there's always something going on. There's always some sort of issues. So we always just kind of add this precautionary budget. It's not a ton, but just kind of give us a little bit of breathing room to protect ourselves a little bit further. And then obviously finally we round it off with taxes and insurance. So you can see this is this is our current operations. This is what we think are stabilized. So what we call our monthly net operating income, which is just your total income minus your total expenses before the mortgage. Those are our figures here. So now we're going to go into the mortgage figures. The reason why we have two different figures is typically on the first year, we actually get an interest-only loan because we're buying distressed property, whether it needs work or is not performing well. Lenders understand that it's going to take you about a year to quote what is called as stabilizing a property, which means either doing the repairs or getting all the rents to market rent. So first year they allow us to do an interest-only loan. And then year two, does it become a fully amortizing 30-year loan like you might be used to on the residential side? And that's how we kind of come up with our monthly cash flow figure. So you can see year one, I mean, on this deal in particular, this one, it's in an area that we're really high on. Year one, we're not going to be making a ton on cash flow, but once we can really stabilize the building, that's where we're creating all the value. Where we think we can get about $2,000 per month in cash flow. Very quickly as well, what I'm going to do is I'm just going to run into our, sorry about that. I'll run into our assumptions about how we calculate ARV, like Willie talked about. Sorry, Excel is being funny. So if you look here. On this particular property, we bought it for $925, and the way we like to project after repair value on these particular types of buildings, that's a 4-unit building, is we could do what's called a cap rate valuation. So basically there's a market cap rate. You might have heard that cap rate term being thrown around. It's basically just is the return. It's a cap rate is basically a return for a property that you can expect per particular area. So, depending on exactly what cap rate you use, we think that building that we bought for $925 that we're going to stabilize is going to be worth somewhere in the ballpark of say 1.1 to 1.2 million. And you can see the equity we're creating because again, we're buying the building for $925. We're only putting $50,000 into it in rehab, and it should be worth about $150,000 to $200,000 more.
Based on the increase in rents, basically, right? So that's
based on the increase in rents.
That's where all of our value is coming from. An asset can only be as worth as much, no matter how good the building looks, as much as the income that it's producing. If you take a distressed asset, or in this one, a monetary distressed asset, run out a physically distressed asset, and increase those rents, you're increasing the value of the building. And that's essentially that's why he described this as kind of the easiest one that we're doing, is because basically it's a paper rehab, so to speak, right? We're taking tenants and we're turning over those tenants, increasing the rents, making small cosmetic adjustments, and then increasing the value there, and that's where you get that 925 to 1.1. Before you hop on to Warwick, Lior, let's answer a couple different questions. The first question I have is, what percentage does the hard money lender receive from the deal? I'll take that one. I think maybe I misspoke, or maybe I was misunderstood. The hard money lender, if I understand your question correctly, doesn't own a percentage of the deal. The hard money lender is basically, we go into a hard money lender and they say, you're buying an asset that's 50 cents or 60 cents on the dollar. What's your exit strategy? And they know from working with us that our exit strategy is to refinance this property into a more conventional loan. So the hard money lender doesn't own a piece of the property. They're a temporary placeholder for our construction. Maybe what you meant was the private money lender. And depending on how we structure the deal, in that particular example, the private money lender didn't own anything either. It was basically the private money lender would come to us and say, here's $200,000. I understand that I can't receive, when we're offering them 12% on their money, right? A 12% annual return. I can't receive 12% in the stock market, or I don't typically see that in the stock market. I would invest my 200,000 with you guys. I understand what you're doing, and then we pay them monthly for the use of their money. And then once the property is stabilized, we go back to that final lender. And then there was another question on here. So am I walking away with $187,000? And the answer is no. We're taking that $187,000 out of the property and paying back the private money lender, right? What we have at the end of the day is an asset that's worth $1 million that we only owe $800,000 on, meaning we have $200,000 in equity, but we don't actually have any cash in our hand. We essentially just bought a rental property for none of our own money, if that makes sense. Give me 1 second. Sterling asked about the slides. Certainly, if you email me afterwards, I can certainly get the slides over to everyone. 1 second. What rate do you pay the hard money lender? About 12%. We usually typically pay a hard money, not a hard money lender or the private money lender. So hard money and private money, they're about the same, about 12%. You try to get in and get out and rehab these things as quickly as possible. I know somebody else asked about timeline. Depending on, we're going into this property. Lior's getting ready to give you an example on Warwick Street, property we just bought in Roxbury as well. This one, I think our construction timeline is about 5 months.
Yep.
So we're paying essentially 1% a month. And that's part of the reason. It sounds silly. We can probably do private money at 10%. But I always offer 12% to our lenders because it's so easy for everyone to understand in the transaction. The lender knows, or the private money lender knows, if I lend you $100,000 and 1% of that comes back to me every month, 12% annually. If you hold my money for 3 months, then it's $3,000. I get 103 back when the loan is paid back, and it's just a lot easier for everyone to understand. To answer your question, hard money and private money is somewhere around 12% is typically what we pay. Give me 1 more second. What is the value you associated with the percentage expenses? It is a GPR. I'll get back to that one. I'm not quite sure I understand that question. Give me 1 second. Can you explain why the tenant rent is so low when you buy it? We'll go into this one and then we'll move on. Can you explain why the tenant's rent is so low? I'm not sure. I mean, this is probably for those of you who own rental property. This is something you to consider. But some people think that they're being nice. And again, I understand that some people are going to think I'm insensitive by the way I say this, but please understand we're pressed for time here and I don't have a lot of time for sensitivity this evening. So some people think that they're doing people a favor by keeping their rents low. And they are, but essentially what they're doing is you're devaluing your property at the same exact time, right? When you go to sell that property, let's say, as I'm looking at Warwick Street on his screen, we own 23, 25 is right next door, and let's say that's a 3-family as well. The uneducated investor would say, well, they're right next door and they're in similar conditions, so they're worth the same thing. That's not true at all. If I'm collecting let's call it $3,000 a unit from unit 23, and the next door is collecting $1,000 a unit, why would I pay the same exact thing for those two buildings? It just doesn't make sense. So why the rents are so low, I can't speak to that. That is to the old owner, but I know for us it's an opportunity to purchase something at $925 and bring it up to $1.1 million or $1.2 million. If his rents where they should have been with the market, he would have been asking a lot more for that building. So I would encourage you, as landlords and investors, find the right balance between helping your tenants in a time of need, but also making sure that you're staying up with the market so you're not devaluing yourself when you go to sell into the future. And Lior, I'll let you kind of take it back and kind of go from there, and then I'll answer some more questions after Warwick.
Okay, so let's go through Warwick Street. Okay, so the next deal that we'll walk through is a little bit more complex. So this is our building on 23 Warwick Street. If you look on a map, it is right on the line of Lower Roxbury in the south end, right next to Northeastern University. So we bought this building vacant. It was in very bad condition. So we're completely gutting the building. We took it down to the studs. We're reframing it, putting in brand new plumbing, electrical, and then gonna completely have brand new 2-bedroom units that are more than likely going to end up being some sort of Northeastern student rentals. So with that being said, I'm going to pull up our deal analysis sheet for Warwick. So on this one, I'm going to go a little bit. It's a little bit of a different format because this is a construction deal, right? And when you have a construction deal, we have to really account for timelines, holding costs, you know, to really make sure we have our numbers very, very tight.
And Lior,
so if you look,
sure, if you can speak to the fact that this one is also a little different because in this particular example, the first example that I gave, we raised debt and we basically kind of cashed everyone out, right? On this one,
yes.
We actually have equity partners that are going to be in this deal with us for the long haul. So if you can speak to that as well.
Yep. Yeah, I'll show that part too, for sure. So I'll just give you guys a very quick overview of the building before we get into how we raised the money. So we bought the building, you can see here, for $960. Our rehab budget is about $250,000. It doesn't sound like a ton for a gut rehab, but the building is actually a really small building. It's only 1,800 square feet. The units are only going to be about 600 square feet. So even though it's, you know, we're not building a lot, we're building on really small square footage here. So, and we're staying actually pretty close on track to getting to that 250 number. Next, we have to account for our soft costs, and our soft costs basically, they actually account for our financing costs. So while we do construction, right? So, you know, we bought the building in January. We are obviously not receiving any rent from January until September, which is when we hope to lease the units. So every single month we are losing X amount of dollars. And actually, if you look right here, this is the monthly debt during construction. So we're losing about $3,500 per month. So we got to account that into our soft costs, as well as, like Willie said before, taxes, insurance, water, sewer, all other good stuff. Our timeline on this, I have it as 9 months on here, but this also includes construction as well as lease up. So we do think we're going to be done with construction by May or June, and then you know, we're looking to hit the September lease cycle because these are student rentals and they're obviously on a September cycle at Northeastern. So by the time we lease everything up and finish the project, we think it's going to be about 9 months. You can ignore this line. This one doesn't really apply here. So here's our ARV. So what we think the building's worth on the back end is about $1.5 million. So if you look at the summary right here, this is, you know, this kind of gives very bluntly the equity creation we're doing, right? Our total all-in cost, right, when you add our purchase price, our rehab, and our soft costs, is about $1.28 million. And our total ARV, what we think the building's worth after, is about $1.5 million. So our total equity, once we finish construction and lease the building up, is about $220,000. Which is obviously fantastic. So in terms of investors, so you know, this gets a little bit more complicated, but as Willie said, on this particular deal, the person that funded our 25% down of the 960, we actually gave them a portion of the deal. So for the total, we gave investors 40% ownership of that building. So again, what it means is for that 960, which if you do the math out on your calculator, comes out to about $240,000. We actually raised probably closer to $300,000. You know, we gave away ownership to investors of 40% of the deal. And again, it's kind of a win-win, right? Because for the investors, you know, these are typically professionals working in their industries that just don't have the time, you know, nor the resources to really pull off big gut rehabs that take 9 months. You know, so they can invest their money into these deals and get a very large percentage of the building. And for us, you know, we are obviously the operators doing the work, you know, pushing the project through, getting everything done, and you know, that's why we take our own split.
Spending 18 months to get the thing under contract and close as well.
Yes. Yeah, that was a fun deal. So what I'm going to go through real quick now on this Warwick deal, I'll show you really quick what we think the back end, once we lease the units up, what we think it's going to look like. So we have 3 units. They're going to be 2-bed, 1-bath units. that we think we can rent out at $2,900 per unit. You may think it's a lot, but it is right on Northeastern, right by the Ruggles ski stop. It's an incredible location, and after doing quite a bit of comps and digging, we actually think this number might be even a little low. So we're very optimistic about this $2,900 per month. Again, you'll see the same vacancy that you saw before on the other deal on Mount Pleasant, so we get our total income of about $8,300. Very similar operating expenses here, right? We've got I'm not going to go through all of them, but it's taxes, insurance, same maintenance, property management. This is the quote unquote other budget here. I called it the trash and snow removal, and then water and sewer. And then we have our monthly mortgage payment of $4,800, and you can see that the monthly cash flow here is about $1,200. Not as sharp, not as good as maybe Mount Pleasant, but again, this is a much better location. This is if you will, it's a Class A location because it's right on the T, right where all the students are, right next to the South End. So typically when you go into these really nice, higher end locations, you're typically getting less cash flow.
This is
now in terms of,
sorry if I can interrupt you for 1 second, Lior. This to be quite frank, this is not the typical deal for us. Not something that we would invest in every day. Not something that you would typically see us spend 9 months of our lives, or call it even more if you include the acquisitions time, to make $1,200 a month. But like you said, because of the equity that we're creating, because of the incredible upside of being so close to Northeastern's campus, and the fact that we already own a good amount of cash flowing properties, we kind of went out and, I hate the term, but this is, call it what it is. This is one of our trophy properties. This is more of we're in that neighborhood, and it's more about the upside of the appreciation. I don't encourage anybody, especially if you're new, to invest for appreciation. You can see what happens, to markets. But that was what this was for us, and we just believe in. For those of you who are familiar with, the Roxbury area, the Northeastern campus, my wife and I both went there. They are buying up everything in that neighborhood, and I wouldn't be surprised if this building was purchased by them at some point in the future as well. So I'll let you continue.
Yeah, they're going to be our seller or our buyer down the line.
Yeah, hopefully.
So yes, and so I'm just going to really quickly show again how we're coming up with this ARV number. Again, we use a cap rate evaluation here. So you can see the cap rates here are much lower than they were on Mount Pleasant deal. Here, they're around 5%, because again, you are right on the South End, which is basically almost as good of a location as you can come around in Boston. And these are going to be freshly gut renovated condo quality, top of the line units. So it's Class A quality in a Class A market. So, these are going to be valued at around a 5% cap rate, we believe, which is where we're getting that at about $1.5 million after repair value. The one other thing I will say about this valuation is we do check all of our valuations by the comps method as well. And, there are plenty of condos in the area if we wanted to, that we could sell at about 500, probably even more, $500,000 per unit. So again, we think 1.5 million is a very good number, and very fair for that area and for the type of product that we're building.
Okay, let me answer a couple more questions, Lior. I'll let you, and then let's as we're getting a little deep into this thing, let's kind of fly through the next two, and then we'll kind of open it up for questions entirely. So question, wouldn't the taxes increase with the property value increase? Absolutely. I find that in my experience, it takes about a year for the assessor's office to catch up to the tax increase. And if we didn't show that in the example, our apologies. I think he has a more detailed amortization sheet that we can spend an hour just on this sheet, so we probably didn't go through that entirely. But yes, the taxes do increase over time with the property value increase. What is the value associated with, if somebody can ask this question again and maybe another way because I'm not fully understanding it, what is the value you associate the percentage expenses to? What is the value you associate the percentage expenses to? Is it GPR? Do you understand that, Lior?
I think the question is like, that 5%, 6%.
Gotcha.
It's of gross monthly income. So whatever a gross monthly income is, so if it's $9,000 for property management, we do $9,000 times 6%, and that's our estimated property management fee.
Um, what lenders do you use, and do you have a rapport with them? Don't want to name drop anybody on the webinar, but if you'd like some connections, please, that's part of what we do. Reach out to Lior or myself, and if you have a deal lined up, or if you just like to build a connection, I can say this though: if in this business, rapport and connections are everything. We do not just go to a random bank and say, here's a deal that we have, can you give us money? It is a long process of building, not a long process, but it's a continuous process. We're constantly sitting down, having lunches with new lenders, had lunch with Eastern Bank and Wellesley and Needham and a bunch of lenders long before we even needed their help, financing a deal. You want to be able to have that connection and build that rapport. So absolutely, if you need hard money lenders, if you need a connection with a commercial lender, please reach out. And depending on your specific needs, I don't want to send everyone to anyone. There are certain lenders that do certain things well. There are certain lenders, depending on your experience level, that you'll fit with it, to fit with better as well. And I'd rather learn a little bit about you and what you're trying to do prior to just sending you to anyone. Do you have an address? Do you have to address this now? But maybe somehow starting out, would you find? Give me 1 second. This thing is so hard to read. Do you have to register this type of passive? Okay, there's another question. Do you have to register this type of passive investor deal? 506BC. You're talking about SEC and syndication concerns. When we raise private money, we are not going out there and doing a free lunch. We're not going out there and talking to people that we don't know. Syndication concerns, if I can keep this really, really simple, only apply to is if you're going out there and advertising money, or you're, raising money from people you don't know. If I want to go to my aunt and my cousin and raise money, that's fine. If my cousin wants me to refer me to their friend who I now have a connection with, that's okay as well. But I can't solicit myself as a securities investment, so to speak. So yes, we are familiar with the SEC guidelines, but this is not something that needs to be registered. These are, and we don't meet numbers and other things that don't necessarily need to be taken care of. Give me 1 second. I think that's it for now, Leo. If you want to dive into the next one. This is Washington Street. Give me actually one more. How do you know the area cap rate ranges? Just experience it some other way. So how do you, Leo, I'll let you kind of answer this one. You talked about a 6% cap rate in Dudley. You talked about a 5% cap rate in the South End. How do you get those numbers, or where are those numbers coming from?
Yeah, so those numbers it's kind of you learn them from other people in the industry, typically lenders, brokers, commercial brokers, residential brokers, other investors, developers. There's no database of cap rates, right? And there's no official cap rate for an area. I mean, at the end of the day, cap rate is just, again, if you think about what the definition is, it's just the type of return you're willing to take for a specific type of property in area, right? So everyone's flavor is a little bit different, but generally speaking, you talk to enough people, you'll get a feel that, hey, South End, Back Bay maybe are usually around in the 4%, maybe 5%. If you start going out into quote unquote worse areas, your cap rate typically increases. So you kind of got to talk to a lot of people in the industry to really get a feel of where the different cap rates are for different types of buildings and areas.
Yeah, and you can do it pretty quickly. It's not, you'll get a sense of what's what. And then the last one, and then before we move on to Washington, if you plan to rent to college students, would you allocate more money towards maintenance and repairs? I assume the underlying assumption is that college students are reckless, which is fair. No, I think what we'll do is we'll probably take like I said, I mean, if we're renting for $3,000, that also means that we have $3,000 security deposit on top as well. We don't rent to anyone without a security deposit, and I feel comfortable that if we have $3,000 and we are properly vetted, we're properly vetting these people, then we won't have an issue. But I probably wouldn't allocate any more money to maintenance and repairs than your typical building. Maybe slightly, because like I said, the turnover is going to be annual versus somebody else who was there for 5 years. So maybe there is a little bit more, money towards painting and stuff like that as these things start to turn over. But like I said, we're going to lean heavily on, making sure we get the right people in, and then obviously taking a security deposit for anything that goes wrong. So Lior, I'll let you
Keep in mind though,
go ahead.
and I'll just say one more note about that. Keep in mind that maintenance and repairs typically stem more from things like electrical and plumbing. So on buildings, when we're going in and completely gutting and putting in new electrical, new plumbing, it just decreases the risk that we're going to have calls like leaky faucets, something wrong with the toilet, something wrong with lights, right? Those are usually where you're getting the big annoying maintenance calls. So on a building like Mount Pleasant, where we're not necessarily gut rehabbing, the chances are we might have a little bit more maintenance there than something like on a fresh, brand new product.
Exactly. That is most of our plumbing is. I have a very good relationship with our plumber. Talk to him almost every day, except for this week since he is in quarantine. But yes, that is where the most of your issues come from. And this is going to be a brand new building, all new electrical, all new plumbing. But again, there is again, I don't want to, pigeonhole anybody, but there is the underlying assumption that we're going to have to pay more because college students are a little bit are careless, so to speak. So let's dive into Washington Street, and then we'll kind of take some more questions after that.
All right, so I'm going to zip through Washington Street. So Washington Street, as you can see here, was a 6-unit existing portfolio. So there's two 3 families, and then this little gap in between them is actually also part of the deal. That land is permitted by the city of Boston to build 3 units. So all in all, once we build the 3 units here, it's going to be a total of 9 units spread over 3 buildings. So we broke the deal down by into 2 phases. Phase 1, your quote unquote phase 1, is just the existing 6 units that we bought, and then phase 2 is the 3-unit development. So I'll run really quickly through the 6 units. I mean, this is very similar to the Mount Pleasant structure. You can see that we bought the 6 units at about 1.42 million. Again, really quick, we've got closing costs, we've got repairs. In this particular deal, the reason why we only have $45,000 in rehab is only 2 of the units were delivered with tenants, and you can actually see them right here. They're in red. The other 4 units of the existing units were actually very turnkey and in good condition. So when Willie said up front, we don't typically buy turnkey stuff, that is typically true, but on this particular deal, because we kind of got a unique package, we ended up getting turnkey units that were actually below market value, which was fantastic. So that's why this number is kind of low here. So again, this is all your financing assumptions, your loan. So really quickly, this is our income. So like I said, we have 2 units that we receive with tenants. Again, you can see that the existing tenants are paying very, very low market rent. Basically $1,200, which is basically 50% of close to 50% of what market rent should be. And then the other 4 units, we actually already filled them up within about 3 weeks. So now all 6 units are fully leased out.
Unit 4 is actually at 2,300. Not that it matters for the purpose of this, but yeah, it's actually 2,300.
Well, there you go. So it made the numbers even better. Here we go. We filled up all of the other 4 vacant units, and you can see by year, once 1 year passes, we expect to be able to stabilize the other 2 units and really get a gross income of about $14,000, which is fantastic. Some very similar assumptions on the operating expenses side. We got your vacancy, property management, repairs. Again, the same percentages that we take gross income. So if you look at the formulas here, it's just our gross income times this percentage. Water, sewer, other budget, taxes, insurance, all very standard like before. We're gonna go into our monthly mortgage payments. So again, like before, like with Mount Pleasant, year 1, we're getting an interest-only loan because we're still, quote unquote, stabilizing the property. So we only have to pay interest payments the first year, and then only year 2 does the fully amortizing loan kick in, and we have to pay the full $6,000. In terms of our cash flow, you can see why we really like this deal. I mean, even though we got a turnkey, we got it below market, and we're still cash flowing very, very well on this. Year one, we should be close to $4,000 per month. And even year two, once the full amortizing loan kicks in, we should still be at 3,700 once we stabilize all the units. So, you know, these are great cash flow numbers that we're obviously ecstatic with. So that's the existing 6 units. I'm going to quickly show the pro forma for the 3 units. So this is that plot of land in the middle. So this is the 3 units that we're gonna start to build pretty soon. So I'll give you a very quick high-level summary of this deal. So the land we bought for $150,000, as you can see right here. Our rehab budget, our cost of construction is going to be about $500,000. Again, you might think, well, isn't $500,000 to build 3 units kind of low? So what we have to think about here is these units are also going to be pretty small. We're going to have about 800 square foot units, 800 square foot units that are going to be 2-bed, 1-bath. And these are going to be rental units, right? I mean, we are not going to be building anywhere. We're not going to be putting the same finishes in these rentals as we are maybe in our Warwick Street deal, right? Here, we're probably going to go, you know, we will probably cut out on a lot of costs. We might not do hardwood floors. We might do vinyl. We'll probably go, you know, lower end finishes on the kitchen, on our appliances. You know, so that's why we're able to trim down our construction budget and get it down to that $500,000 mark where we feel very comfortable with. And we've already verified it with actually our general contractor as well. Again, you have to budget for the soft costs because again, we're going to be building this thing for about 12 months, and we're going to be paying more an interest payment on every single month while we're still building the building, right? We're not going to be collecting rent for the first 12 months, so we're essentially going to be losing that interest payment every single month. So that's why it's critical to account for these soft costs. So you can see this is kind of our summary here. Our all-in cost is going to be about $700,000 between the land, the construction, and our soft costs. What we think our after repair value on this, it's probably going to be around $850. You know, that's kind of a low. I took a kind of a low number on this. I think we're actually going to be closer to 900, maybe even a little bit more. But we're going to have about $150,000 to $200,000 of equity. You know, I wouldn't say necessarily a slam dunk deal. But when you combine this with the other 6 units that we were able to get that were at below market value and that are cash flowing so well, it kind of turned into a no-brainer for us. So I'm very quickly going to fly through the cash flow numbers on the 3-unit deal. You know, we're going to have 3 units. We think it's going to be, each unit is going to be rented for about $2,200, which is probably a low number. It's probably going to be closer to 23 or 24. You know, accounting for all our typical operating expenses, our monthly mortgage payment, you know, we should be able to get another all in all $1,200 in monthly cash flow. So hopefully between this building and the 2 existing, we should be at close to $4,500 to $5,000 per month of net cash flow, which is why we ultimately bought the deal.
Cool. Let me do a couple questions, Lior, and then we'll talk about Walk Hill. Washington Street is definitely my favorite of the most recent things. I think that was a good solid deal altogether. What is your end goal for number of units? Are you trying to replace your current daily income needs, or to hit a number where you'll stop buying and leave properties for other people? Who asked this question? I can't see the name. Oh, that's our friend Daniel Collins. Yeah, we plan on leaving something for someone else at some point. No, that's good. Thanks, Daniel. I think the goal for everyone is, I mean, I would assume I got into this business to replace my annual income needs, right? I mean, you know, if we get to a certain period where cash flow replaces those needs, will I stop buying? I'm not really sure. I will certainly slow down and start looking at other projects looking at other things. I will be buying projects that have a little bit less, I would say there'd be a little bit less pressure at the end of the day to perform. Maybe you get into some flips or some condo conversion, but right now, yes, the end game is to replace the income, and I'll let Lior kind of answer that one from his side as well.
Yeah, for me, I think it's probably a little bit less on the income side. I kind of play the long game with these rentals, and I'm more focused on the equity and building up my balance sheet. I'm still on my younger side, so I'm producing monthly income through my brokerage business. So it's not like it's not like I have to replace my income. I really want to build out just a full-scale company out of this that can really be operational and really build into my network.
But I believe you said you had partners with this deal. I assume this person speaking about Washington Street. Yes, we kind of briefly skipped over that, but to answer your question, very similar to Warwick Street, we gave up about 40% of that deal. So when Lior talks about about 5,000 monthly cash flow, 40% of that would be going back to our investors to keep that answer really clean. Yes, that one we raise. There's two ways to kind of raise money for any project. There's debt, and then there's equity. Debt is what we kind of went into this thing with. A couple other deals that we didn't talk about today were debt. These last couple have been equity partners, and we may, with the current market, go back to debt depending on how things play out. Usually I think of value in properties and cap rate for more commercial properties. For residential, usually people see a CMA. Are you doing both? And again, Lior answered that. Yes, we're doing both. We're looking at, in terms of our values and figuring out an ARV, we're looking at CMAs. We're trying to figure out what what are condos selling for? If we got ourselves in trouble, can we cash out and sell these as individual units? If the multifamily, say our commercial budget ballooned and our rehab budget ballooned, can we get out as condos? And then we're also looking at what are other multifamily selling for that it can be completely rehabbed, which is tough because you don't find too many gut rehab multifamilies with sprinkler system and fire alarm system and everything brand new. But then that's why we're kind of defaulting to the cap rate as well. But yes, it is typically used for commercial properties, but we're finding it useful for ourselves as well. And the banks are going to use that as a possible measure as well. Give me 1 second. So difficult to see in the small screen. I have another meeting starting now. Thank you for doing this. Very informative. Rich, no problem, Rich. We hope to see you on the next one. Give me 1 second. What's the process you take to get the rents increased in a year? So that's a good question. I assume they're talking specifically about Mount Pleasant. Mount Pleasant. Rents are super low. There are two approaches that we're going to take. We're first going to build a rapport with our tenant base. New ownership is in town, and we're going to basically try to go in and say, hey, what are the problems that you have with this building? What are the pain points that you have about living here? What are the things that you don't like? And that first few months is us building that rapport and saying, can we put a new fridge? Can we give you a new stove? Is there anything that's leaking? Is there a window that's drafty? What are the things that we can do to improve your life and your quality of life here? Then it's a conversation about, well, like I said, obviously, that, and most of the people I have yet to run into a person that doesn't know that they're on a good ride, right? Everyone knows that the ride is going to end when you're paying $1,200 for an apartment in the middle of Boston, and you know that your neighbors are paying $2,500. You know that it's going to come to an end at some point. So I've never caught anybody off guard with this conversation. But the question becomes is, what can we do to kind of get these numbers back up to where they should be? And just having that conversation, everybody reacts differently. Some people are like, dude, I was already prepared for it. Just tell me what the number is. And we have that conversation. A lot of times that we find, and specifically with Mount Pleasant, they are all voucher-based tenants or voucher holder tenants. So it's more or less, it's having a short conversation with them, but more or less negotiating with the housing authorities as well. And that's why we like this deal. It's going back to the housing authorities, and the housing authorities are well aware of what is going on in the neighborhood and what rents are. So having that conversation with them and getting those rents back up. Give me 1 second. How are you finding your deals? We'll speak to that in just 1 second. Let's get through Walk Hill and then we'll touch on that. I keep buying until Mayor Walsh gives I say keep buying until Mayor Walsh gives you the key to the city. Yeah, thanks, Tyona. How are you finding your deals? I think that's the last question. Let's move on to Walk Hill, and then we will go into a couple more things about acquisitions and lead sourcing as well. So Leo, let's fly through this one and then get to the rest of the presentation.
Sure. So the last of the 20 units that we're going to talk about. So this one's still kind of in the pipeline. So this is our Walk Hill project in Mattapan. We've already closed on the land. So I'll give you the quick backstory because I think there's some lessons to take out of here. We first put an offer on this piece of land with a zoning contingency, and basically what that means is that we went under contract with a seller, and then we had 8 months to go through the permitting process with the city of Boston to get at least 3 units approved, right? So we knew we could put on at least 3 units. We were hoping our kind of home run number was 4 units, and our slam dunk number was 5 units. So we had 8 months went by. We did not finish the permitting process, but because we felt really comfortable with how our community meetings have been going with the abutters and how and the reaction, we decided to close on the land with equity partners. So very similar structure as Warwick, where we raised the money on this particular piece of deal. On this deal, we had to raise the entire purchase price of the land, which was $150,000, and I'll pull up the sheet so you guys can see, or $130,000. I'm sorry. So it was $130,000. So we raised basically that entire amount and closed on the land cash. We are still finishing up the permitting process. We were supposed to have actually our ZBA hearing this past Tuesday, but obviously with coronavirus, a lot of this has been delayed. So our hearing now is going to be in May. But basically, we got neighborhood support and abutter support for 4 units. So when we first ran the numbers, I actually ran 3 different scenarios. 1 scenario for each number of units, right? So 1 scenario for 3 units, 1 scenario for 4 units, 1 scenario for 5 units, and basically making sure that regardless of what happens, we were still making money and it was still a good deal for us. So this particular sheet is our 4-unit deal analysis. Like I said, we're pretty hopeful. We're not to curse ourselves, but we're pretty hopeful we're going to get that approval from the ZBA, as we've already gotten written support from the local associations in Mattapan. So to give you a quick pro forma numbers on this, here's how we think it's going to play out. We're going to buy this build. We already bought the land for $130,000. If we're going to build 4 units, we think it's going to cost us about $800,000 to $825,000. That's probably a little high, to be honest. Again, like the Washington Street deal, these are going to be rental quality units, so we're going to be able to figure out how to skim a lot of cost on finishes. We might consider not putting things like central air. So there's going to be decisions for us to make on how we can kind of cut cost. As these are going to be, rental units rather than condo units. Here we're going to have plenty of soft and financing costs. So, here we've incurred architectural fees. We had to hire an architect to draw plans for us. We've had to hire a zoning attorney to take us through the permitting process. We've had to do plot plans. So this has been a very involved process. So that's why our figure here for our soft costs is much larger than typical. Because this is a new construction deal that we've had to take basically from A to Z. So, we think it's all in all, since closing, we still think we can get the construction done in about 12 months with an extra 6 months to finish up the permitting cycle. So all in all, we think it's going to take about 18 months or so. So to give you an idea of, the spread, our all-in cost is going to be about $1.1 million. And that's, again, the purchase price, the rehab budget, and the financing costs. Our total ARV, which is based on a combination of condo comps and the cap rate that we've talked about before, we think is going to be around 1.35, 1.36. So once we're done with this, we're gonna have about $250,000 in equity once we kind of build up that building. You know, and then real quick, we'll run through the cash flow. So, you know, actually our numbers I put the sheet together at this point almost 12 months ago, which is when we first started this deal. You know, we thought we're going to be on average about $2,400. I think today we're actually going to be closer to $2,600. So this number is probably pretty low. But anyway, we still have our typical.
It'll probably be more than that. It'll probably be about 28. We're offering parking with this thing as well.
That's true. That's true. I mean, I always write very conservative numbers, so I know you like to push me on that.
No, I got to push the envelope. That's the job, man. So,
yeah.
Yeah, 28.50 is somewhere about what I'm shooting for the 3-bedroom units. You know, with parking, brand new construction, open floor plan. These things will be pretty nice at the end of the day. So we'll see. But either way, I mean, the performance. And I also don't think it'll take that much for that cost that much for us to build. But you know, we'll see. Yeah.
Again, we like to be safe. We definitely like to see the numbers on the safe side in case for whatever reason we have to take some adjustments or cuts and make sure that we're not losing our shirts, because that's priority number one. Not losing our shirts, and as well as our investors' money. That's also really important. So that's why we do have very conservative underwriting. So you can see the typical operating expenses here again. Your taxes, insurance, maintenance, property management, all the good stuff we've talked about before. So all in all, again, with these conservative numbers, we should be about $2,200 per month cash flow. You know, as Willie said, I mean, there's probably upside about $400 per unit. So I think there's no reason why we won't be able to push about $3,000 to $4,000 in gross cash flow. But you know, this is the number that we looked at 12 months ago and said, hey, if this is the number that we have to take today, are we okay with this? And we were. So which is why we ultimately pulled the trigger on it.
Cool. Yeah, and this was very similar. Like I said, we raised some debt on equity partners on this one. And though this has taken us a lot longer than anticipated, it's going to be a good one. I'm really excited about this one as well, and hopefully ZBA can get us through. You know, next month. So give me 1 second. Let's talk about a couple more things, and then we will let everyone go for the evening. We're going to make this really quick. When you're doing these things, like Lior said, we tend to be very conservative on them. We don't want to sell a dream to a potential investor. We present numbers that are conservative with the goal of pushing the envelope and making the numbers better, reducing our construction budget, increasing our rents, and making that performance at the end of the day better than what we presented. So people always have, and it's some of the answers. If you didn't ask these questions, these are some of the objections that I come across. When we talk about the BRR strategy or creating equity, what if Lior says basically, you know, 1.3 million? What if the bank comes in and says your property is only worth 1.2 million? Okay, well, we still created a good chunk of equity, but what if we can't refinance out of it? Well, we can always sell the property. We're never in a position where we owe more on the property than the property is worth. If that's the case, we can always get out of it, or we can go to condos and get out of it that way. What if you overspend on a rehab? Same exact situation. There's been a couple situations where we've overspent on rehab, and what we'll do is we'll get like a private secondary loan, right? So you'll have your primary mortgage plus a private secondary loan, and typically we'll find that there's enough cash flow coming out where we're not putting that much money in our pocket anymore, but it's paying off that secondary loan if we'd like to keep the property. What if you can't find a PML or a private money lender? On the front end, we go into this we put up our own money as deposits, but there's always some type of contingency that allows us to back out. Unless it's a sweetheart deal, we're going to have some type of contingency on there, and it's either a zoning contingency or mortgage contingency, whoever. If we go and lock up a piece of property and we can't find a private money lender, then we back up out of the deal and we get our deposit back and move on to the next one. We are never scared to lock up a deal and go into it. We don't go. We want to protect our reputation. It's a small industry, a small city, only so many agents out there, and people actually doing business. So we want to protect our reputation, but we have no issue locking up a deal. And if we need to back out, because there's a global virus, then we need to do just that. Rents aren't as strong. What if the rents aren't as strong as we thought they were? Same exact thing would affect appraisal. We'd probably sell the building. We find that what we do as investors is super conservative, right? If you look at a building, a 3-family building, we can always open this thing up, get 1 unit vacant, maximize the rents in the other 2 or 3 or whatever the building is, and probably find an FHA or a conventional buyer that would absolutely love to move into one of these properties at the end of the day. We can probably sell Warwick in a heartbeat if we fixed it all up and it was available to somebody with a conventional loan. So we're really never afraid to go into these things. If things go awry, we always have enough room to actually sell and just get out of it. Our investors didn't get the performance that they like, but at least they're not losing any money or losing any of their principal, and they probably make a small return. You can't find an end loan. Let's say we rehab an entire property, we rent it up, but now lending is dried up and we can't find. Same situation. We look to get out and just sell. What if the appraisal comes in high? What if Lior basically says it's 102 and it actually comes in at 103? Then we are in the money and we are basically popping bottles at that point because we made an extra $100,000 more than what we anticipated. So we mentioned this. If you're looking right now for, and I'm going to let Lior take over in a second and tell you a little bit about how he finds properties and the things that he's doing. I just want to wrap it up because we are getting a little late here and I don't want to keep anybody too long, but we're looking for distressed properties at the end of the day. There's market distressed, which means 2008, 2009, the whole economy was hurting, right? So it's a market distressed property, a situation where everyone's hurting and we're going in and we're buying and holding on for the long term. There's personal distress, meaning somebody is going into foreclosure or bankruptcy or divorce or probate or whatever the personal situations are. And then there's property distress, meaning they're current on their mortgage, but like the image in the background, they just can't take care of the property. I drive by something like this in Dorchester. We focus our time, or I focus most of my time. Lior owns some stuff on the North Shore. I own some stuff on the South Shore, but most of our portfolio, Dorchester, Roxbury, Mattapan. I drive by something like this in one of those 3 neighborhoods. I'm immediately calling Lior. Let's go after it. I'm knocking on the door. I'm dropping a letter. I'm doing what I can because this property right here tells me that this person can't take care of this property. Peeling paint everywhere. Their mail hasn't been collected. They can't even come out of their front door because there's hedges growing through the front door. Somebody is either moved away from this thing, doesn't care about it, or, like I said, this is a property that we would target. So these are the kind of the signs that you would look for and kind of looking for these things. And I'm going to really quickly go through this, and hopefully this is really easy for you guys to all understand. One of my pet peeves is new investors that want to get into the business. They assume that, every deal that they have is going to work out. And Lior, you can speak to this as well. We look at probably 100 deals between the two of us every single year. We probably do an analysis on 40 deals every single year, right? And that means Lior's going in there crunching numbers, blah, blah. Then we probably get an offer accepted and we go further and do some due diligence. The seller, can't get out of probate or whatever it may be. There's something always that goes wrong. Financing. Right now we're having a little trouble. I wouldn't say problem, but financing is tightening up because of this virus scare, right? So at the end of the day, if you want to close 3 or 4 deals a year, you have to build a massive pipeline. You have to talk to everyone. You have to go out there and let everyone know what you're doing. You can't just have a couple leads and, like I said, you can't build a business like that. You have to really treat it like a business and understand your deal funnel at the end of the day. We'll send you slides. I don't want to go too deep into this, but this is, lead generation tactics. I'm going to let Lior tell you how he's finding stuff. But this is some of the ways that you can work on, like I said, building your lead generation pipeline. Quick piece of advice, don't do all of these. Pick 2 or 3 things that work really well for you and focus on those. The money is really in the details and the nuances, and you really can't do all of these things well. But I found deals through in each and every one of these sources, with driving dollars probably being the best. Give me 1 second, Lior. And then I'm going to kind of back up one second, and I'm almost done here. So a question that I often get, and that's why I kind of threw this in here, is asset protection, or kind of the structure. I see a lot of people going out, and one of I won't say mistakes, but one of the ideas that a new investor may have is basically going, I'm going to start my LLC and now I'm a business, right? So they have Dream Big LLC, and the idea is to buy all these rental properties within that LLC. That's great. Actually, it's not. I'm not gonna lie. It's not great in any front. This is the way we structure kind of everything, right? Each individual property don't necessarily need the holding company up top. But let's say if we take out the holding company, each property, Warwick Street, Walk Hill, Mount Pleasant, are all owned in their own LLC. And the reason you would want to do that, I apologize for those of you who can hear my son crying in the background. The reason you would want to do that is because the liability that I have at Warwick Street, right, with partners there, if somebody slips and falls on that property, you don't want, if you own everything in one LLC, that now affects your entire portfolio. If someone slips and falls at Warwick Street, or a contractor hurts themselves and we get into trouble there, that liability is isolated into that one LLC, and it doesn't affect what's going on at Mount Pleasant or Washington Street or Walk Hill, if that makes sense, right? So the idea that you're going to start Dream Big LLC and dump all these properties into there doesn't make sense. We create an LLC. It's 123 Main Street or 123 Washington Street LLC. The LLC has its own particular partners that might be different from Property 2's LLC, and though that LLC owns the individual rental property itself. So let me back up here, and then Lior could talk a little bit about lead generation, and then we'll answer some final questions before we wrap up.
Yeah, so I was just going to give a quick high level on what we're doing for lead generation. At the end, like Willie said, you can't do everything. You got to just choose a couple of channels that you can really focus on, learn how to dominate and excel in. So for me, and what my group does, I do a lot of cold calling. It's not the sexiest thing in the world, but that is how we got Mount Pleasant. We literally just dialed the owner up. Had a conversation with them and said, hey, are you thinking of potentially selling? And you kind of go from there. So that's one big thing for us. Very similar to, could be door knocking. Basically any way to get as a face-to-face conversation with owners, especially multifamily. What we found in around the greater Boston area, especially Dorchester, Roxbury, Mattapan, a lot of these owners are older folks that have owned the buildings for quite a long time. So, we've tested it. We've tried to do things like Facebook ads before and lead capture and squeeze pages, but we've just found that, your average 60, 65-year-old man or woman is not going to go into your squeeze page and, fill out a form. So we kind of go more old school tactics. So cold calling is definitely big. Direct mail is another really big one for me. We're sending about 1,500 pieces every month right now. It kind of has its hits and misses, but if you're doing it in a consistent period over a long time, it's going to work. So yeah, direct mail, cold calling, and then the other big source for us is broker relationships, right? Me and Willie both talk to tons of agents every single day. And anytime I'm talking to anyone that I know does business in that area that I'm looking at, I always tell them, hey, if you know of a 3-family or more that's distressed, that needs work, that's got low rents, hey, give me a call. I'll give you an offer within 2 hours. I'll give you an offer within an hour or two. At least you can present it to the seller and see if you can get the deal done. So, those broker relationships are definitely also another instrumental component for us.
Yeah, no, absolutely. And if you're a broker on this call, like I said, any distressed property you have, like I said, we're interested. And again, like I said, we tell brokers, come to us, and we're brokers ourselves or agents ourselves, but we're not trying to co-broker or anything like that. Our interest is in the property itself. How did you go about financing?
We never took commission.
Yep. How did you go about financing on Washington Street? Does the loan start at IO and then go to fully amortizing? Yes, we set that up. What it's called, if you were looking for that type of loan structure with the bank, it is called a temp to perm. So a temporary loan, they understand that we are going through a 6 month to 12 months to 18 months. We had 18 months actually on Washington to build. That's why we're not as nervous about this. City shut down right now because we do have some time there. Interest only period. And then we convert once the property is stabilized to fully amortizing. So yes, that is the way that we structure that. And even on stuff like Mount Pleasant, did we do the same thing on Mount Pleasant?
It's all the same. It's all,
Yeah.
most of these deals are temp to perm.
Attempt to perm. So yeah, so even on something where we're getting money right from the start, we still kind of went fully attempt to perm as well. So how long are your leasing periods usually for your units? 12 months, typical. We have some temporary tenants right now, but typically 12 months, very common. This is great, Willie. Just wanted to let you know I'm here. Thanks a lot, Dorothy. Greg, how did you know financing a Washington Street loan? Give me 1 second. New construction, are you separating the meters and billing water and sewer back to the tenants? No, I don't think so.
I don't think we are.
Yeah, I don't think we are.
No.
I mean, I think I've from my research, I think the cost outweighs the long-term benefits of it or long-term savings of it. I mean, I think I did a model a little while ago and you really wouldn't see a payback period. I think it was like 20 years or something like that. It just wasn't, it didn't make a lot of sense for us.
On our scale, it doesn't make sense.
Yeah, I think exactly. I think if you were, I know I had some friends that lived at like Avalon Summit or like, one of those larger 60, 70 unit complexes, 100 unit complexes, and it makes sense there. Lior, what is your cold calling success rate?
It's low. You got to do really high volume. I mean, I'm usually, our conversion rate is probably somewhere between 0.5 to 1%. So, and that's full conversations. I mean, we typically hammer the phones I try to set out about 2 hours a day at least. Usually in the morning where I can bang out some calls, have some conversations, get some contacts in. And I know one out of every, about 100, it's not a great rate, but one out of every 100, I'm going to have a great chance at either doing something with that lead.
Give me 1 second, guys. I apologize. Oh, there we go. Perfect. Give me 1 second. When driving for dollars, if you find a vacant house, let's say, how do you find out who the owner is and how to contact them? One of the benefits of being an agent is we have access to public record. We can quickly go on MLS, put in 123 Main Street and find out immediately who the owner is. If you don't have MLS and you don't have access to public record, there is the Registry of Deeds. You can do it the old school way, go to Registry of Deeds, Suffolk County Registry of Deeds.com. I'm not really sure what the address is, but you can go there. Or secret backdoor option is you can find a friend who is a real estate agent, and every real estate agent has access to add administrative assistance to their portfolio. So if it's a good friend of yours and they don't mind, they don't think that you're going to mess up their business in any way, they can give you administrative access. Offer your friend to help pay for their MLS subscription. They give you administrative access, and now you have access to public record, which you can easily use to look up deals there. Give me 1 second. What's next? How much stock do you put in appraisals for the property value? Are you ever concerned they're going too high to support the loan? How much stock do you put in appraisal? How much appraisals for the property value? Are you concerned they're going too high to support the loan? You know what that means? You know what that?
Are we worried that we're going to underappraise? Is that the question, maybe?
But what does he mean by though? I'm sorry, whoever asked this question, give me 1 second. I don't fully understand that one. Zach, if you can rephrase that in some way just so I can help answer the question. Not sure I fully understand that one. How do you find deals? We just answered that. 1 second. There is a cap rate report. I'll share the link with you. Perfect. Didn't realize there was a cap rate report. You don't have to address this now, but I think we already answered that one. Give me 1 second. All right, Zach, I think you're one of the last ones. If you want to put that in. How long do you plan to keep these buildings? What is your exit plan? call it what it is. I mean, Lior's in his 20s. I'm in my 30s. Both of us have 20 plus year timelines. We're not buying assets that we don't want to hold on to that, for that, at least that long. I mean, we may consider doing 1031 exchanges, moving up, moving on at some point. But right now, I don't, unless you have a different answer, Lior, I don't think that we're buying anything that we're not planning on holding indefinitely, or until, some period in time where we feel that we no longer want to the asset or plan on moving on. But this is not something that we have a 5-year timeline on. Let me speak to this then, because this maybe will clarify that question a little bit more as well. Our investors, when they come in, let's say you have $100,000 with us, to tell an investor that you plan on holding a property indefinitely is a little tough, right? I mean, so we're saying we're holding it indefinitely, but our goal is to refinance the property within 24 to 36 months and get that investor's money back to them, right? So the same BRR strategy that we talked about in the beginning, where we're basically taking a private money lender's capital and getting it back to them and bidding out, we're doing the same thing for our equity investors as well. So we're basically saying, you own 10% of this property. You put in 100 grand. In 24 to 36 months, we're going to hopefully cash you back out. Your money is the first money out. We're never going to take a dime out of this until you get your money back out first. They get their 100 grand back out. Plus, they own their 10% of the property as long as we own the property as well. So they own 10% indefinitely, which increases their ROI to a number that you really can't calculate as well, because they've now gotten that money back out of the property as well, if that makes sense to everyone. Give me 1 second. How has the recent pandemic affected your rental income properties? Too early to tell. Unless you have a different answer, Lee, or too early to tell.
Well,
I mean, everyone I talk to says April 1st is a good indication, but I think May 1st is probably a better indication of whether we've taken a hit or not.
Well, one thing I'll say is I think of our portfolio, do we have any market tenants? Most of our, I think either we might have maybe one non-Section 8 tenant, and that kind of goes a little bit into our, it's partially strategy. We've talked about this in the years past, like we believe that Section 8 kind of gives a little bit of a cushion in the face of a recession, right? Because obviously there's a lot of talk right now nationally about tenants not being able to afford rent. At the end of the day, we're doing business with the government, right? I mean, our tenants have minimal portions, right? Usually from $50 to $150, $200. Most of our gross rental income is really coming from the federal government. So, as of right now, unless there's some subsidy changes within HUD, which we really hope there's not, because then we're in for some big problems. Our rental income should really not be, we don't foresee changing that much. And even with our new construction projects like the Walk Hill and the Washington Street ones, we're gearing up, and hopefully we'll have, more subsidized tenants that, will give us more cushion in case this recession gets any worse.
Yeah, I mean, I do have some market rate tenants. I have a few in the buildings I bought, earlier on, and it's just too early to tell right now. I mean, April rents seem to be, coming in already, but too early to tell. I think, and even as I'm talking to business partners and family members, I think May is really going to be the real kind of benchmark and see where, kind of what this thing is, how it's hit us, so to speak. So, interest rate the same for temp period as it is for the permanent period. Yes. They do not change that interest rate, for the deal. What's your favorite deal of the 4? I think the sexiest building is Mount Pleasant. As you can see that we love brick buildings. I think 3 of the 4 are brick. Mount Pleasant is the most appealing building. I like them all. I mean, Warwick is probably the best area. But if I had to choose one, I think Washington Street would be the one that I would say, if the other 3 went away, Washington Street would be the one that I would want to keep, mainly because it's 9 units, at the end of the day. And it cash flows the best. And at the end of the day, I am a cash flow investor. But I'll let you speak to that answer as well, Lior.
No, Pretty much the same. We both talked last year and had a goal of also buying some more brick buildings.
Okay.
We're both sucker for brick, so we ended up hitting that pretty well. But yeah, Mount Pleasant's a really good looking building, and Washington Street's a great cash flow play. So yeah.
Have you deletted all the properties or look already to deceased? All of our properties are deletted. I think I probably personally, outside of our partnership, probably own one unit that's not deletted, but we operate in how do I put this, a market. Like I said, Roxbury, Mattapan, and Dorchester tend to be voucher-based or heavy voucher-based neighborhoods, and you can't go into BHA or Metropolitan Housing or one of the other Cambridge housing authorities, any of them, without having a lead paint certificate. You probably wouldn't even get the unit approved. All of our stuff is deletted at the end of the day. Have you ever utilized the 1031 exchange? No, I've represented a bunch of clients who've had 1031 exchanges, have done 1031 exchanges, but me personally, I've only sold a couple pieces of property, and the 1031 didn't make sense since I needed the actual cash. Lior, do you leave voicemail messages?
No, because if you
Oh,
imagine
you're cold
yourself.
calling. Okay, I thought you meant like
Yeah.
personally, like. Okay, I got you. For cold calling. Yep. Okay, there you go.
Yeah, I don't, because if you think about owners, if you think of yourself as an owner and you get a voicemail from some rando talking about your property, you're probably going to give him the middle finger, right? So I found that it's best to try to have the conversation with them live, rather than try to leave a voicemail where you're probably causing more damage than good. But other people have different opinions.
Lior, Rozhansky at gmail.com, right?
Yes.
All right. Is Lior's email. So everyone, you have Lior's email now as well. Soft costs added to financing. Depends on the lender you use. Some lenders allow soft costs to be added in. Some lenders do not. So that is a good question when you're going to the lender. Soft costs, for those of you who are not familiar, architectural drawings, soil tests, things that are not physically going into the building, right? Demo is physically, as a part of the, the construction of the building, wood, supplies, materials, that's all those things go into the building. Soft costs are anything that's invested prior to drawings, soil tests, plot plans, all those other things. Those are, I would say 50-50. Some banks allow it, some banks do not. We tend to seek out the banks that do allow those soft costs to be put in there now. Do you look for specific investors, or will you take anyone's money? Fair question. No, we will not take anyone's money. I've turned down more people than I've brought on. I want to see that you have some liquidity. Even friends and family, I've had to turn them down because they want to get in. But the last thing I want to do is invest your money into something that's a long-term investment like real estate. Have a global pandemic hit us out of nowhere, and now things are different, right? Now our timelines are extended, our ZBA date is pushed out, our financing is a little bit tighter, and now you're coming back to me and saying, I need my money. I didn't have enough in savings, and I didn't think that this thing I lost my job. I want to invest with people that have liquidity, have a certain type of savings. That's my primary thing. My primary thing is the liquidity position. And then I personally, how do I say this in a nice way? I don't want somebody who doesn't really trust me at the end of the day, because there's only so many questions that you can ask, right? Ask all the pertinent questions, get as much information as you can, but at the end of the day, there's going to be a certain level of trust that needs to go into these things. And if there's a person who would really just kind of like, they appear as if they're kind of they're going to cause problems for us down the line, we would rather just walk away from that funding. It's not, all money is not created equal. So to answer your question, no, we don't take financing from just anyone. I know you've talked about creating multiple LLCs to protect your assets. I'm wondering if you think the appraisal banks are accurate. Oh, wait a minute. Hold on. I think I kind of crossed myself over here. Wait a minute. 1 second. I know you talked about creating multiple LLCs to protect your assets, which is great, but wouldn't that create a nightmare when it comes to accounting? Yes, one of the things that we talk about every single day. It absolutely does create a nightmare for accounting.
Yeah.
But at the end of the day, it's a give and take. You have to just, decide. You put everything into one LLC. Now it's a nightmare legally for yourself, right? I never went to law school, but I can tell you that any good attorney is going to try to. If I'm going to sue you, I'm not going to say, well, I'm suing Willie Mandrell and the Mandrell Company, and the Mandrell Company owns 25 different properties. But my client only slipped and fell on Walk Hill. I'm only going to attack that property. That would be a foolish mistake. That attorney, it really just need to be disbarred. That would just be foolish, right? I, as an attorney, it is my right to attack everything that you own. I'm going to go after everything, but that's the benefit of having separate entities, right? Technically, I don't. You sue me personally. Lior is protected with the assets of the LLC. And again, if you didn't do it that way, what investor would want to invest with you? Now everything, I'm coming into a pool that has so much risk there. Why would I ever want to put my money into that? I want to segregate or mitigate my risk by putting it into separate LLCs. I think you would have a hard time finding investors who are just part of some big pool of investment and big pool of risk. I think that would just be, though it does, yes, absolutely create an accounting nightmare. I think it is probably the only way that I found that makes sense to do it. Give me 1 second. Do you think the coronavirus situation will depreciate the ARV on multifamily properties in the greater Boston area over the next few months? Lior, I'll let you tackle that one.
No. So first of all, we haven't seen any price shifting as of yet. I think usually what you see when a lot of equities like stocks, become volatile, a lot of people go into what's considered a safer class of asset class, which is real estate. So actually multifamily I think will be just as competitive, just as valuable in the next 3 months as it will be in the next 18 months. I think it'll be one of the more stable asset classes. And especially in an area like Boston, I mean, I talk about this all the time, but we're huge believers in the long-term potential of the Boston market. And that's, you see so many industries here, so much foreign capital. It's hard to see prices dropping. It really is. I mean, even in 08, even, a lot of the areas around here kind of stayed pretty, relatively stable. It's hard to see rents dropping. There's too much going on here. I might eat my words in a month, or in a month or 12 months, but it really is. It's hard to imagine rents and multifamily values getting wiped out in a market like Boston.
Lior, have you ever tried texting for leads?
Yep. Send text all the time. Yep.
All right. Do we look for parking spaces on this property, on these properties?
Parking is always a bonus. I mean, again, for the kind of product we're delivering, it's not really a necessity. It's certainly nice, but we've certainly bought property that doesn't have parking and still get very, very competitive rates, especially when we have voucher tenants.
Okay. What percentage does a hard lender receive from the deal? I think we've already answered that. How long do you hold these properties? We've answered that. Can we receive the slides? Anybody who wants the slides, in the chat section of this, you received my email address as well as Lior's. Please send us an email. Please give us a couple of days to turn it around, but we will get to this copy of this video as well as the copy of the slides to you as well. You'll have to ask Lior if he wants to give up his spreadsheets. Okay, that has been answered. So you walk away. One more question. I believe that is it. So yeah, I appreciate everyone hopping on. We ran a little late, just a tad, but we hope this was informative. a lot of information to put on a webinar. But hopefully you got something out of it. We both think that there's plenty of opportunity out there. There's going to be more opportunity out there in the coming months. Keep your eyes open, keep your head up. I know some people, including the people maybe on this webinar, there's going to be some tough months ahead. It might be a tough year, but keep your eyes open. This is the stuff that makes or break investors, moving forward. This is these are the times, right? I mean, for those of you familiar with some of the bigger, lenders out there like Endeavor Capital, you see, if you're familiar with Dorchester, Roxbury, Mattapan, their signs are everywhere, and they didn't become Endeavor Capital until the last recession. I mean, they were Endeavor Capital, but they really kind of exploded by, I was, I tell you a short story, I was selling them multifamilies foolishly at 250, 275 for 3 families back in 2009, 2010, because I didn't quite get it. So pay attention to what's going on. Keep your head up. Don't be like everyone else. If you're going to take advice from people, make sure that they are where you want to be in life. One of the things that I found is I was taking way too much advice from my aunt and my cousin and what they thought about the current market and what I should be doing, and my uncle, but they weren't where I wanted to be or doing the things that I wanted to be, and that was just foolish in hindsight. So look for people who are where you want to be, pick their brain, ask them, take them out to lunch when we're allowed to go back out to lunch, like I said, but there is great opportunity out there. Definitely look out for it. So I don't know, Leah, if you want to share anything about yourself, and then we can kind of talk about some last closing things before we wrap this up.
Yeah, I mean, I was just going to say, in terms of the outlook, I know that there's a lot of questions for the next year, but the way I'm kind of approaching it, both of my investment business and the brokerage businesses, we're going to have to do a lot more work right now. It's definitely going to get a little tougher. Everything's going to get a little tighter. I think you're going to have to do a lot more work to get the same results. So, we're still trying to crush out offers, get as much construction work done on the investment side, just as much work on the brokerage side, just to get the same results that we were getting last year. But I think, kind of like Willie said, I think a lot of people that are able to kind of walk out of these tough times with their head high and with some momentum typically do very, very well. So I think right now is really the time to capitalize. It's going to take a lot of pushing and shoving and a lot of work, but I think it's one of the better times right now to really go out there.
Yeah, a couple quick things to wrap it up. Like I said, we appreciate everyone's kind of sticking it out with us tonight. Got a large, some number of people still on this webinar with us. If you're looking for a home, if you're a real estate agent, I mean, this guy is a marketing wizard. He won't tell you, but I'll tell you. I mean, he calls me every day with something new that just kind of blows my mind. So, and that translates on the sales side as well. So if you're looking for a new home, he's over at Compass. Him and his partner Taylor Johnson are building out a team. Would love to kind of talk to new agents, so definitely reach out to Lior about that as well. If you need lending referrals, please give me a call, whether it be hard money or commercial lending. Please don't call me and ask me to refer you to our private money lenders, because that's just not going to happen. But if it's commercial, referrals, if you need that introduction, it's always nice to kind of, instead of walking into a branch and saying, hey, can I talk to you? Get that lending referral. If you have deals, we're also looking for partners as well. If you're an agent and you're out there, you're finding something, you're not quite sure how to get into this business, come to us, bring us a deal, and like I said, we're open to kind of showing you how we get these things done and making you an equity partner, in that transaction as well. If you have a deal and you're all set, you're a wholesaler or an agent, you want to blast something out, send it over to us. There's about 2,300 members on Boston Wealth Builders email list right now. The gurus will tell you the first thing that you need to do when you start the wholesaling business or your rehab business or whatever, go out and build a buyer's list. The buyer's list is already here for you. Just, send it over. Give me, 24 to 48 hours. I'll turn it around for you, get it out to 2,300 local investors within the Boston area. And then if you're looking for coaching, mentoring, or anything like that, reach out and we can talk to you a little bit about that and whether you fit within the program or whether the program fits for you. We can talk about your needs and what you're trying to do. So once again, a little late. Hopefully, most of you were eating dinner while you were watching this thing. It's time for Lior and I to hop off and kind of, go get our dinner now. So we appreciate you, spending the time with us. Hopefully, this was informative, and we look forward to chatting with each one of you, hopefully in person very soon. So thanks again, guys.
Thanks, guys.